So you got a 0% down mortgage, but why the heck are you still bringing thousands of dollars to close? Hi, I'm Sandy Guide. I'm a mortgage loan officer at Harbor One Mortgage here in Londonderry, New Hampshire, and I want to explain to you about closing costs today because that is a big part of purchasing a house. Closing costs are costs associated with purchasing a home that are in addition to the minimum required down payment amount. Most loans have a minimum down payment requirement such as 3% or 3.5%, maybe even 5%. The closing costs are separate from this and include things that need to be paid to third parties for the services that they provide as part of the home buying process. I'll go over each of these in detail so you understand what they include. Closing costs are generally about 3 to 5% of the purchase price. So when you're looking at homes to buy, you can use this as a general rule of thumb to try to figure out how much you would need at the end of the day on top of your down payment requirement. So if your purchase price is $350,000 and the required down payment is 3%, you'd be looking at $10,500 as the down payment plus closing costs and prepaids, which is another $10,500 to $17,500 for a total of anywhere between $21,000 and $28,000. So keep in mind that the closing costs and prepaids I go through today aren't an all-inclusive list, since there may be variations depending on your loan type and the lender, but this will give you a pretty good idea of what's typical. So when you apply for a loan, your lender is going to give you an estimate of what fees they would charge. So be sure to go through these and know what the loan will cost you before you move forward. So the first fee is the lender's administration or origination fee. The majority of lenders will have an administration or origination fee, which is just their fee to cover overhead expenses of running their business. It's usually in the range of $1,000 to $2,000 per transaction. There may be times that these are waived if they're doing a special program or something like that, but typically this is going to be charged by every lender. Number 2 is the appraisal fee. Most loans are going to require an appraisal to determine the value of the home you're purchasing. So this fee will range, but usually is in the $500 to $1,000 range. This is to pay the appraiser for their work to inspect the property and to draw up the report, which is pretty involved. The appraiser will need to come out to the property, inspect it, and then find comparables in the area that have sold recently, as well as do a market analysis to determine the value. This fee is typically one of the fees that need to be paid upfront prior to the loan closing because it's used to pay the appraiser for his or her work. So even if the deal falls through after the appraisal is completed, you usually won't get this fee back because it's passed through to pay the appraiser. Number 3 is the credit report fee. There is a fee to pull your credit report, as this needs to be paid to the credit reporting agencies for the information that they provide. This is anywhere from $100 to $200. Number 4 is a flood certificate. Most loans require the lender to pull a flood certification to confirm if the property is in a flood zone or not. If it is, the lender would need to require flood insurance on top of the standard homeowner's insurance that buyers would need to get. The cost of the flood cert is usually only about $10. Number 5, title company fees. The title company is not very well known by the public in terms of what they do in the home buying process, but they're a very, very important piece of the process. The title company searches the title of the property and makes sure there aren't any liens left on it or issues that might come up once you purchase it. They also offer insurance to both you as the buyer and to the lender in the event there's an issue after you buy the home. So for you as the home buyer, the insurance from the title company is called owner's title insurance, and for the lenders is lender's title insurance. They're separate fees, anywhere from $200 to $1,000 each. The title company also has their administration type of fee, which they usually call a settlement fee, which is their fee to cover business and overhead expenses as well. They also conduct the closing at the end of the process and ensure all of the official documents get recorded with the Registry of Deeds and are part of public record. So whatever the state or town charges for this process will be passed along to the buyer as part of the closing cost. These are transfer tax fees, etc. These costs will vary by town and state, so look through your loan estimate carefully so you know what's being charged. Number 6, prepaids. Prepaids are items that you pay in advance, such as daily interest charges, homeowners insurance, flood insurance, HOA dues, and funding fees, depending on the loan program. For the daily interest, you will prepay the daily interest for the remainder of the month you're closing in, and then your mortgage payments start on the month after, the first full month after you close. So, for example, if you close on October 25th, you will prepay your daily interest for the 6 remaining days of October, and you won't have a payment due until December 1st. Another item included in prepaids is your annual premium for your homeowner's insurance. The first full year is required to be paid up front, and you can either pay it prior to closing or at closing. If you pay the insurance, so the whole year at closing, the full year's amount is going to be included in your closing cost as a prepaid item. There are other items that may be included on here and will be listed under the prepaid section of your loan estimate, so make sure you look that over so it makes sense to you. Number 7, your escrow account. Most loans will have an escrow account built into the servicing of the mortgage, although you can waive this feature for some loans. An escrow account is basically a savings account that the mortgage servicer will set up for you to collect your homeowner's insurance and your property tax payments each month, and then they will take care of making the payments to the town or the insurance company when they come due. So each month, when you make your mortgage payment, the monthly amount of your homeowner's insurance and property taxes will be included in the monthly payment. Then each month, the mortgage servicer will take the portion for your insurance and the property taxes and deposit it into your escrow account so that when they come due, there's enough in there to make the payment. So when you first close on a mortgage, the lender will determine how much is needed to start the escrow account up front so that by the time the taxes and insurance are due, you have enough in there to make the payment. The amount they collect will just depend on when you're closing on the home and when the property taxes and insurance are due. This will be a large chunk of the closing costs, and it can freak some people out. But just understand that these are costs you would need to pay anyway once you own a home. So having it set up is more a budgeting tool that simplifies your life rather than fees that you're paying to close on a mortgage. So those are just the basics of what the closing costs on a mortgage entail. When you go under contract on a home and you submit the purchase and sales to the lender, they are required to send you a 3-page document called a loan estimate that will outline all of these costs for you. You're free to apply with multiple lenders to get a copy of their loan estimate so you can compare each lender using the same exact form to determine who you would like to use to close on your house. Hopefully this video helped. And if you have any questions on closing costs or how to read a loan estimate, or if you want me to look at your loan estimate, feel free to reach out to me and I would be more than happy to help.